But there are people in all different walks of life that do like innovation, and they do like trying to change the world one company at a time, and they do love supporting the next generation of entrepreneurs. And those are the people that we have in our community. So it sort of self-selects, which means that I'm surrounded by this group of really interesting and motivated and ambitious people.
The New Zealand Tech Podcast, brought to you by Gorilla Technology, proactive and strategic IT.
Greetings and welcome along to the New Zealand Tech Podcast. I'm your host, Paul Spain, and great to have Robbie Paul with us, who's the Chief Executive at Icehouse Ventures. How are you, Robbie?
Good. Yeah, great to be here.
Yeah, great to catch up. Always lots going on in the world of venture capital and tech startups, so really looking forward to hearing the latest from you. Before we jump in, of course, a big thank you to our show partners, to 1NZ, Spark, 2 Degrees, HP, and Gorilla Technology. We appreciate their support of not only the New Zealand Tech Podcast, but what they do in the broader tech and innovation ecosystems across New Zealand. Well, let's jump in. I guess it'd probably be quite good to start with a bit of an overview for those who don't know. What is Icehouse Ventures? What's the relationship with the Icehouse? How does that whole picture fit together?
Yeah, sure, Paul. So Icehouse Ventures is a venture capital firm that invests in New Zealand companies, primarily software, hardware, medical devices, gaming, fintech, you name it. Some of the companies we've been behind are Crimson, Halter, Partly, Sharesies, Mint Innovation, Dawn Aerospace, Tradeify, who sold last year, and 352 in total, growing by sort of a couple a month. So always adding new promising entrepreneurs to the mix. Our mission is very simple. We want to get out and find and invest in and support New Zealand's brightest entrepreneurs. And we start investing from day 0 or -1 or -100 forever, as long as possible.
Yeah. So walk us through a little bit about how you got started. What were those kind of the earliest days of the Icehouse Ventures? Because there was that connection with the Icehouse, which is, I guess, in those early days was something of a kind of a startup accelerator. Would that be sort of I'm not sure if that's quite the right terminology, but certainly, these days they've probably changed shape and you've evolved from, probably a part of that in the early days, was it?
Yeah, that's right. 2001 was when the Icehouse was established. It was established to sort of advance entrepreneurship and business in New Zealand. And it started with these owner-manager programs, which were sort of Stanford MBA-inspired programs that would bring together people running large established New Zealand companies and get them in a group and teach them and train them and inspire them and help them grow and run their businesses. That still goes. And they've run, hundreds of those programs with thousands of owner-managers and many other permutations where they get more deeply ingrained with typically large, established, New Zealand-focused companies, and they do that really well. A few years later, the incubator started, which was for startups, and a few years after that, the Angel Network started, and then many years after that, the funds management business started. And I joined in 2008 when it was an Angel Network and an incubator, raised the first fund in 2013, and that was $500,000, and now we're just shy of $500 million in venture capital to invest.
Wow, that's good. Now, for those who don't understand what an angel network is or angel investing, maybe you can just break that down as a part of the picture.
Yeah, I'll have to remember not to use too many different terms. Angel investors are individuals that are high net worth and choose to invest their money or some small portion of it into early stage companies, and do so for equity. This is not a loan. They're buying shares in a company and typically do so with the intention of also helping the company to achieve its vision and grow and become really consequential. And if that happens, then a lot of good things happen. People make money, entrepreneurs learn, new products are built, industries are disrupted, problems are solved. And New Zealand was very unique, and I think I'm very lucky to have been around in the time that I've been, because the angel ecosystems in other more established markets had a lot more complexity and competition to deal with. There was many more family offices. There was many more corporate VCs. There were many more venture funds. There were many other sort of versions of investors that could have invested in startups. And from an entrepreneur's point of view, New Zealand, I think, was disadvantaged and slowed down a bit because it didn't have that vibrant sort of capital ecosystem that it does have today. But in 2008, 9, 10, when I was first involved, the angel networks were a very large proponent of the investment ecosystem. And the result was that Ice Angels and myself got to interact with lots of really cool companies in the early days and get pretty established in the market.
Yeah. Now, you mentioned family offices. Some might not be so familiar with the family office, but they'll be part of the group that would invest with you today, right?
Correct. Yeah. A family office is typically just a managed group that looks after the assets of an individual family or sometimes multiple families. And usually those are associated with individuals and families that have vast wealth, and where it makes sense to start to have management brought in-house. And so, we're very lucky. I mean, we have all of our funds to date have been just from wholesale investors. There's about 2,900 of them. And then there's about another 100 family offices or so that have invested, as well as Kiwi savers and other institutions. So.
Yeah, that's great. So you're really very well connected across the wholesale investment community in New Zealand.
I think so. I mean, we're lucky. I don't think we're out there sort of changing people's minds. I think there's a very small subset of individuals that have the wealth, but also have the propensity to invest in this space. And that's who we want to connect with, right? I think if you know commercial property really well, just stick at it, right? Like if you're not comfortable with technology and with the sort of entrepreneurial ambition that comes with startups, don't bother, right? But there are people in all different walks of life that do like innovation, and they do like trying to change the world one company at a time, and they do love supporting the next generation of entrepreneurs. And those are the people that we have in our community. So it sort of self-selects, which means that I'm surrounded by this group of really interesting and motivated and ambitious people.
Yeah, that's really good. Now, if we look at the traits of the companies that you've invested in, what would be the things that have really, that really sort of stand out to you, that particularly those that have, you've got involved in the earlier days, and then, I guess because you do invest, as you say, from very, very early on, right?
Yeah, that's right. And I've actually been looking at this recently. So, 352 companies that we funded, 74 of those companies have failed. 33 companies have delivered positive returns. And so the question I was trying to ask and answer is, can you observe any differences, right? Like between the ones that weren't successful and that were. And the one data point that sticks out is that the ones that became successful at a much higher rate, you could triangulate back to why those individuals started those companies, right? So Fadi Mashriki is studying wireless power at the University of Auckland, a world leader in wireless power research. He starts a company. It becomes power by proxy, sells to Apple. Pretty obvious why he ended up in the business he ended up in, right? That is not as true in the 74 companies where there were failures, right? And so I think, especially at the initial starting point, we like to look for people who have very unique perspectives on the world that are informed by real pain or real problems or real experiences or real research that they've been involved with for a long time. Second thing is just sheer resilience. Like, failures happen. It's a fact. Yeah. Get over it. Yeah. And that's, hopefully most people can get to that point and accept that. What's more difficult to intellectualize is that most of the companies that have succeeded and sold had one or many visceral dances with death, right? Where they didn't have any cards. They were back against the wall. They were, out of money, you name it. And they came through and succeeded either in a short period of time or a long period of time. And so then the question is, okay, well, I've backed a company. It's going through hell right now. What is this the moment where they survive to become successful later on? Or is this the moment where they don't? And at least my experience now with the 350 companies is you have to be very led by the entrepreneur on that basis, right? Venture capitalists are not running companies, right? They are investing in teams that need to pull off the impossible and work super hard and front up to challenges, and we're just there supporting them. So it really does fall back on the entrepreneur. Do they want to give it another go? Do they back themselves or not?
And so when you look at those scenarios where companies you've invested in have had their back up against the wall, as it were, what does that tend to look like? Are there sort of similarities of how they've responded and got out of those sort of difficult places, which I guess can come through challenges in the economy, challenges in the specific market, challenges with their customer base, challenges internally, but often a pretty big element of that is financial challenge, right? That's kinda, ultimately that's what tends to lead things to come to a grinding halt quite quickly.
Yeah, you're right that it is a culmination of things that have to come together for an entrepreneur to give up, right? I think startups and entrepreneurs and frankly the investors that support them are way more patient and resilient than most people would expect.
Yeah.
You realize that the average time for those 74 companies to fail was 6.5 years, right? Like I think it's portrayed in the world as sort of an entrepreneur, gets up, tries an idea, raises money, and it doesn't work. They just throw the towel in. And that's just the most ridiculous thing ever. It's just not true, right? And then the other, view is, public markets are down. Have entrepreneurs given up? It's like, are you kidding me? That this is not how they operate, right? They need to be taken down as a result of, a customer falling through, a product not working, a competitor encroaching, and then as a result of maybe some of those things, shorter cash runway or the inability to hire somebody or the inability to go to a certain event or the inability to close somebody. And then because of that, you can't raise as much money and on it goes. So they don't wave the flag lightly. To answer your question, the ones that come through, I mean, I wish I could pick up a pattern, but usually it is by finding people who believe in them, either customers who will pay early, pay more, pay in advance, and give them a chance, or investors to give them that extra runway to get through.
Mm. And when because it seems like you've said yes to a lot of companies, when you look at those that you've said no to, what are the most common traits?
Well, look, the only ones that I care about, right? Because I think a lot of firms like to talk about sort of their top of funnel. I've talked to 1,000 companies, and as a result, that should suggest that I'm picking the right ones. And it's like, well, actually, I don't care about how many we talk to. I care about the ones that do have the features that we want, right? Like phenomenal founders, huge markets that are growing, real obvious technical moats that they could build, you name it. Like, do we get to talk to those companies, right? Equally, for companies that we decline, I don't take pride in just like saying no to lots of companies, because guess what? It's way easier to be a cynic in this business than it is to be optimistic, right? Because you're more likely to be right if you are negative than if you are positive. And
that's true. And some of those ones that you say no to are going to go on and do really well, right?
Yeah,
you're
phenomenally.
Not going to pick them. You're not going to pick them all the time.
Totally. What a career. I mean, you're not flying the plane. You can't pick winners. You're going to say no to some really great ones. So what exactly do you do as a VC? And when you go through that thought process, it's like, well, there are a few things I can control, right? I can control my desirability as a source of capital, right? What do founders think of us as a potential investor, and how I approach investing, and how rapidly I invest, or what terms I accept, or do I follow on? Like, there's lots of things you can control, but you're right. Like, there's going to be companies that you are completely convicted in, and you're wrong, and the opposite will also be true. And so I don't look at the ones that we just say, like, I mean, there's blanket red flags, right? If a founder seems dishonest, apathetic about the mission, just trying to make a quick buck, has the wrong thoughts on sort of how they're going to use the capital, has no sort of intellectual edge, then those are all easy no's. But it's never that simple, right? I mean, think about some of the really great companies like Cami and Aura that have emerged, and take yourself back 10 years and compare what those businesses were then to what they are today. And you could see why it would be easy to say, oh, this is a difficult business, but obviously you would be wrong if you had made that call.
Yeah. Who would be the two biggest well-known names that you said no to?
I mean, those two are pretty real, right? I have to approach that with caution, because if you have sort of like your anti-portfolio, it presumes that you would absolutely have had access, to the rounds, and I don't want to imply that that was a certainty, but we definitely talked to, Cami back when they were notable, and what a spectacular business they've built in educational software.
Yeah, that's true.
And the commonality between Cami and Aura, and then some of the great companies that we have backed, is that the entrepreneurs have gone the distance, and they have evolved into really great company builders and leaders, right? And so I think the most important part of whatever your due diligence approach may be is really trying to determine the sort of heart and mind of the entrepreneurs, because the business is just, and the potential customer of today, it's very difficult to assess at seed stage.
I think that is one of the challenges. And some of the companies I hear about their stories of sort of early on, and you're trying to join up the dots and work out how can this be a great profitable business, and Cami might be one of those where you look at it, and the PDF software for use in schools, and you're kind of thinking, well, hold on, that doesn't sound like a place where you can charge a lot of money and so on, but actually such a massive addressable market. And COVID became a very incredible time for their growth, right? And I wouldn't have picked that. And there's for me anyway, that's quite a common thing. You can kind of look and you can see the real challenge in what they're doing, but you have to be able to sort of see past that and pick the other factors, and recognise that, well, when one of these companies gains traction, although it might not look like an obvious win on the outset, it might well be further down the track.
Or if you think about the propensity to invest in something would come from understanding what they're working on, knowing their market, knowing their customers, being able to comprehend their complete technology roadmap. If those things are true, there's no opportunity. Because if those things are true, the opportunity would have been exploited or has been exploited, and you're too late, right? And so wrap your head around that one. I mean, if you need to be investing in things that are creating markets or changing markets, or need to benefit from a change in market, and that's a difficult thing to predict early on.
Yeah. Tell us about some of the companies that people be fascinated about. Dawn Aerospace. How does an opportunity like that sort of come to your doorstep, and how do you wrap your head around how feasible it is for a business like that to get off the ground, as it were, which they seem to be gone from strength to strength, but sometimes there's still quite a long period of time before these businesses end up profitable as well, right? Yeah,
Dawn is the exception to one very specific rule, which is that we basically don't invest in companies that cold email us or cold call, right? Because if you're an entrepreneur, you need to have the tenacity to be able to get one introduction, especially in a market like this. Everybody's pretty accessible. You can get my mobile number in 2 seconds if you need it. And so, but more importantly, you should have somebody call and, give a recommendation. And so that's a red flag if we just get a cold inbound. It's like, that's not good. Except when it was Dawn.
Wow.
And they actually sent an email to the wrong address, but somebody on the team sort of stumbled across it and forwarded it over to Jason, who was the partner, and Barnaby. And I remember them sort of coming racing around back into the office like, hey, actually, these guys are really legit, and they're very bright, and they're very sort of, Kiwi in their humbleness, because there's plenty of companies out there that have raised hundreds of millions of dollars that call themselves space tech. And you have to ask them 2 questions. Have you ever been to space? And the answer is usually no. Or if you have you actually made any money from it? And the answer is almost always no. And in Dawn's case, the answer was yes to those very early in their journey, which is remarkable. I think a lot of people know them as the space plane thing because that's very visible and it's beautiful and so on.
Yeah.
That's not actually their core business, or it hasn't been. It could be.
It could become
It's
that.
their propulsion systems.
Yeah.
And in the simplest way to think of it is, if you're a satellite, you ride a bus to space, you get dropped off, and you need to get to your specific location. To do that, you need propulsion on the satellite. And it just happens that Dawn had designed a very clever approach that became a globally recognized solution for propulsion systems, and now they're in hundreds of satellites in space.
Yeah, it was quite cool being in their office on one occasion and seeing them actually testing out that stuff, firing them up and giving them a test so they had the confidence of when they're up in space they're going to work as expected. It's pretty cool.
It is a remarkable journey that they've been on in 8 years.
Yeah. What other ones sort of stand out to you as being quite unique and quite interesting?
I mean, this is a little bit recency bias because I just gathered with the team last week and visited some of their customers, which was Halter.
Yes.
So Halter puts collars on dairy and beef cow and train them so you can move them around, you can shift them, you can send them to the shed. You can do all sorts of things that otherwise required you to have a hoarse voice and a loud bike and hours and hours of time following animals around. And the sound bites from some of these farmers and how much it's improved and changed their life was remarkable. And one lady, she was sort of laughing with glee that there was a winter storm, which sort of prompted the need to move animals around to specific paddocks. And her neighbor, who hadn't adopted Halter, was out in the paddocks for 3 hours laying temporary fences in the snow.
Oh, wow.
And she did it on her phone next to her fire, and was very proud of that.
Yeah.
We then drove down the farm and we went past a shed, and they said that shed should be empty this time of year. And it was all their temporary fencing, all the sort of reels and the posts and all this stuff, and it was full. And they don't need it, because once you can create sort of virtual fences, you don't need to be out there laying those for crop management, for staying away from the water, for going to and from the milking shed. And the beautiful thing about Halter is those two farms we visited are not alone, right? They're in hundreds of farms, New Zealand, Australia, and now all over America in multiple states. And I think it's just one of these stories where we're really seeing the companies that were second guessed and were ignored and were sort of cut down, becoming very large companies. Like they won the Deloitte Fast 50, or they were named number 1 last year. Right. They are a consequential company, and they're like Crimson, and they're like Cami, they're like Aura, that a decade ago they were sort of nobodies, right? And run by kids, and now they're sort of the adults in the room. It sort of scares me, like I'm going to be old soon, and but it's a remarkable company that's got great tech advantages, phenomenal team, and just immense market, right? Global.
And when you're investing in a company like Halter, what are you able to sort of bring to the table to help them? Because great having some really innovative technology, but obviously there's a need to build out the right sort of team, often to expand globally and into a range of markets, probably most commonly the US. And, there's, I guess, a certain level of networks and experience and so on that you can draw on. But, I guess what I tend to notice with the companies you've mentioned is generally they've got, incredibly talented leadership who can achieve a lot, on their own and so on. But I'm sure there must be some benefit from your networks and so on as well.
I think there's lots that we can do and that lots of venture capital firms can do, as long as you understand that the entrepreneurs are in the driver's seat, right? Mm-hmm. And we don't wield some sort of magic wand that can change the trajectory of a company. But, when you're building a company, you don't know how much necessarily you should pay your CRO, right? You don't know what a good board pack looks like. You don't know who a good lawyer is necessarily to flip into the US if you need to set up there, right? Fundraising strategy. Like, there's actually no better person to have on your side than a VC who can tell you the actual sort of psychological game that you need to play to raise more money. Right? And so I like to think of the way that, companies get support. One is with like bespoke industry, stage, geographic specific people, right, who can help those companies with whatever the specific needs are. Our goal is to help find those people. And obviously we have a very large network of sort of well-intentioned people who can play that role, right? The other is, sort of ubiquitous needs that are common across Aerospace to an ed tech startup to a fintech startup, which are those things about setting up an ESOP or hiring or pay or directors or you name it. And that's where we can answer questions and provide guidance with data because we have 350 companies. So it's not an anecdote. And the last thing you need if you're an entrepreneur is like a bit of nostalgia and a bit of like, survival bias and an anecdote here or there and somebody waxing on about whatever it is that, they did, right? You just want the answer. And the best thing is to be able to get the answer from other entrepreneurs who have no agenda and who are just a little bit ahead of you, right? Yeah. And so that's sort of our third sort of initiative, which is really to help entrepreneurs learn from and connect with each other. And people think that entrepreneurs sort of like hang out. I mean, they don't. They don't have time. And they're leading their teams. They're trying to please their customers. They're trying to think about the future. Then they got to try to be good family members. They want to maybe have a friend. And then 10 nights out of 10, they have to speak at an event or inspire a high school or whatever it is. And that is, it's the reality. But it's unfortunate because actually time with other entrepreneurs can be really impactful. And so we invest very heavily in building a community where they're not talked at, but they're able to engage and answer the questions for each other with no agenda. And I find that's really helpful.
Yeah, that's really good. And I'm kind of curious around the challenges that we have within the startup space in New Zealand. In the past, raising funds, raising capital has often been referred to as a sort of big problem. By my mind, that seems to keep improving as time goes by. Yeah. It gets easier to raise capital locally. I'm sure not everybody probably agrees with that because there are some areas where it's probably much harder to raise capital than others. I know, it was one of the things Peter Beck used to talk about was how hard it was to raise capital locally. But I think that if you look at Rocket Lab, it's probably a reasonably unique beast within New Zealand and even globally to a big degree. So you can understand some of these conclusions that people will come to, and I guess each circumstance is a little bit different. But what do you see as the challenges that we have today? Is it tax? Is it being able to attract the right sort of talent? Is the capital, still a really big challenge? Where do those challenges sit?
I mean, capital is definitely not a challenge. I would probably provocatively almost say, if you think any of the macro challenges that I could potentially name are going to be the reason your company doesn't survive, then you're wrong. Because for entrepreneurs, they've got much larger challenges trying to build new technology, trying to hire a team, trying to convince the first customer to buy, and trying to do all those things at the same time that you have to be raising money and sort of leveling up and sort of spinning all those plates. And I would also say for every macro challenge, distance, right? Not enough talent, government policy, capital, right? There's exceptions of companies that have just gone straight through. They've knocked down all those barriers and they're totally fine. So I don't want to downplay that it's difficult, but I would probably say it's more difficult building your company than all the other things that are, sort of contributors to the tailwinds that are nice to have, but not required. And, I would also reframe it as like, think about the opportunities that you have now. I mean, international capital is flowing in here at a rate that's never been seen before.
Yep.
Kiwi savers are participating in this asset class more than ever. Other institutions are participating in the asset class more than ever. The Edmund Hillary Fellowship and the Investment New Zealand visas are bringing incredible humans to New Zealand who desire the ability to make an impact on entrepreneurs. Kiwis are coming back and or getting more connected from offshore, and talent is starting to be recycled from within organizations, from the bottom to the top, that have now been part of startup journeys and are ready to do it again. And all those things, I think, make for just like a very forceful combination to advance this ecosystem.
Yeah. How important is that, I guess, sort of, recycling of talent and funds from those that have been, successful in the past? And, I guess, we so often see K1W1 has invested in this or that, often quite early on, which is Stephen Tyndall's, that's his VC fund. And yeah, you kind of see this kind of across the board on many occasions. How important is that?
I mean, it has to be ingredient number one. If you were to write the recipe for success for an ecosystem, it has to be number one. Recycling of talent, right? People build confidence, they build wealth, they build capability, and a portion of them decide that they want to recycle that back into helping the next generation, right? What you're seeing now, which is a really positive sign, is not just an entrepreneur started a company, sold it, started a new company. That's great. And we've backed a lot of those sort of second-time entrepreneurs. It's that when an entrepreneur starts a company, they can hire people, be it, the junior engineer to, like a senior BDR from other high growth tech companies, right? I don't know who it was who said back in the day, you raise money and you have to hire your developers from Microsoft New Zealand or telecom, right? And like obviously fabulously skilled, but a different archetype than the people who've worked in a software development firm, in a startup in New Zealand.
Yeah, sure.
And so now, I don't think anybody loves it, but it is a healthy sign to see a lot of people sort of get poached from company to company.
Yeah. And how does that startup life sort of look now from your perspective? We quite often chat to founders who are talking about some pretty crazy kind of lifestyles working in startup land, and some pretty intense hours and the like that can, I guess, take a toll in varying ways. Is that still pretty common part of the sort of earlier stages of startups, or does that vary a lot depending on the founders and the leadership? And
certainly there's definitely a variation in people's sort of propensity to work all hours, but generally, if you're trying to build something new, you're thinking about it all the time and you're working on it all the time. And it reminds me of that quote from The Big Short where he's like, my wife says I'm unhappy, and the guy says, oh, you're happy when you're unhappy. And he's like, I am happy when I'm unhappy. And it's sort of like, would entrepreneurs, if they were given the choice, literally just shut off on like Friday afternoon and come back Monday? No, that's not what they want to do. They want to build. And so some it's self-imposed, some you have no choice. And pretty universally, everybody digs himself in a hole because to be given a chance to be able to raise money, to attract a good person to your team, you got to sell a vision, and you sell that vision. And the beautiful thing about that is then you sort of put yourself in a position where you have to deliver that vision. And then it turns out to be a hell of a lot harder. And there's, way more complexity. And so there you are, having to compel as many of your team as possible to work as hard as possible, as long as possible.
Okay.
Yeah.
And does that tend to stretch out over quite a long period of time, commonly before these, I guess, is it tied to profitability? Is it tied to sort of particular things where they become maybe a little bit more like a traditional firm in terms of the intensity and so on?
Not if it's up to the entrepreneur. I don't think so. I think you're built in one way or the other. If you had worked alongside your team for a decade to build something really consequential, there's nothing you would want, less than to see people come in and lifestyle it, right, and just hang out. So, no, I don't know if there ever is this sort of point of glory. I've never, I think, reward and happiness all just comes through the journey, and there's no entrepreneur on our list that has sort of like found this new Zen state, and they, they don't want to build. Usually they build something and they want to get back into it, or they want to give back, or they want to hold themselves to a higher standard, or prove that they can do it again. So,
for founders that have done well and then exit and don't sort of get back into the game, do you think that works for them?
Yeah, I mean, there are personality types of folks that really do want to sort of chart a new course, and that's totally their call. So I have to admit, I don't come across too many of them, right? Yeah. But the ones that, and that's probably because, I'm interacting with ones who want to invest, so not the ones who don't want to invest. But it is a personality type where you're driven to, if you are sort of a company builder, you're driven to want to be doing something. So I don't think memberships at Tata Iti sell to people who just want to chill, right? They want to, maybe they just want to apply themselves to a different sort of world, but work equally hard. Yeah.
Now, what can you share about your thoughts on Callaghan sort of shutting down? Because Callaghan's been a pretty big part of the tech startup world over reasonable period of time now, and helping with, I guess, those government grants and so on that have often helped varying companies in this space. How do you think the future could and should play out in this in the regards to where government should be hooked into the ecosystem?
Yeah, I think it's unfortunate. I mean, the good news is it sounds like a lot of their services and a lot of their initiatives will sort of fall within other buckets. And so and that's a level of government stuff that I don't understand that well. So if the truth is that a lot of their approaches and services and support will be picked up by other groups, then that's fine. I would say then that's really unfortunate that they didn't keep the name, because that Callaghan name really spoke to people, right? His presentation and this ambition. And so I really appreciated that sort of nod to somebody in the past, as opposed to just an objective statement of what it is, ministry of X or Y, right? Okay. And I mean, I sort of managed to hold two truths in my head at the same time. One is that entrepreneurs will thrive in any environment, no matter what. But at the same time, that innovators and entrepreneurs have an insatiable appetite for resources and capital and support, and that it's got to be a winning formula as a country like New Zealand, who doesn't want to just export logs and milk, to invest in technology. And so more is better, right? I mean, I wouldn't even bother getting into the debate of efficiencies of X or Y, or how something could be better deployed. It almost doesn't matter. It's like, are we as a nation leaning in to one of the most important potential export groups or not? And so I think, the government's been making some pragmatic changes in favor of entrepreneurs and startups and tech. And in this case, I think they were, potentially just trying to simplify and save a few bucks here or there. But at a high level, I would say lean in. Yeah. It's a winning formula, and it's an important part of the economy.
Yeah. I mean, I guess there's always sort of knobs and adjustments that can be made, and I think, sometimes we would see these grants that were given, and then the other companies would get sold, and there wasn't necessarily a local benefit. So you can, I guess things there like, well, maybe there should be some equity or something in some of those sort of cases, but. Even there, you get challenges, right? So none of these things are you're never going to find the perfect answer for, are you?
Yeah, and I mean, I think generally it was very well intentioned, group and people. So hopefully it does sort of rise up through other organizations, and entrepreneurship stays front and center. Yeah.
Now, I guess a lot of our listeners, they're very, pro the tech world, the startup world, and I guess if you look, there's probably quite a variety across our audience, myself included, in terms of what our abilities are to get involved in startups, whether it's on an investment front or what have you. Maybe you can, walk us through what the options are as you see them for, Kiwis who do think that actually my money shouldn't just go into real estate or investing in the top US sort of tech companies and so on, from your perspective. And I guess, your main audience has been wholesale investors, right? So maybe start by a bit of an overview, because there probably will be amongst our listeners, there's probably a reasonable percentage who could be wholesale investors, but they haven't maybe chosen to go down that track, or they're not even sure what hoops they need to jump through to be a wholesale investor, and other ones that are much more likely to be retail level investors.
Yeah, that's right. I mean, generally the retail investors, and the wholesale versus retail is just a definition by the FMA based on assets or wealth, right? And so wholesale is generally synonymous with being wealthy, although you can actually be quite wealthy as a retail investor and not quite meet various thresholds. And generally, the retail investors have been excluded from being able to participate in that space or in this space. And, I think that's unfortunate, because I've had a lived experience myself as like a 20-year-old, just because of the position I was in, being able to have ownership in aspirational New Zealand companies, right? And I didn't bet the farm, and I didn't invest money that, couldn't lose, or that I needed to pay rent or anything. But I was able to make that choice myself and invest in some really interesting aspirational New Zealand companies and learn from them and feel that pride of ownership, right? Which you just don't get investing in a, offshore index fund, right?
And so why were you able to do that? Is that
my job?
That's a privilege of being part of a venture capital fund, that you easily tick the box of being a wholesale investor, or is there other hoops you have to jump through?
Yeah, and the regulations have changed since 2012, but that's roughly just because of the world that I was in, right? And so most people don't enter the fund world as I did, sort of raising $500,000 and now having just shy of $500 million to invest as sort of like an intern come CEO, right? Most people build a lot of wealth, sell a company or whatever, and then start investing in startups. And so I think that brings a slightly different perspective for me, because I know what the journey's like, and I've had that opportunity to invest, and I know the benefits, and I know the disadvantages, and I know how it fits in with everything else that I have to take into consideration with saving and investment and all that. But I do think it's the lack of retail participation is unfortunate for New Zealand, and it's unfortunate for those individuals, right? And here's why: because I don't think that most retail investors would ever want to or should, invest. It's just, but that's the same with wholesale investors, right? Wholesale, there's a distribution curve. Some that are really passionate and love technology and are forward thinking and want to support innovation and want to help entrepreneurs and want to feel ownership and have more risk tolerance and, are okay with things being illiquid, right? A small number like that, and others are not, and they shouldn't participate. Like they don't want to, they don't need to. And that's the same with retail investors, right? There is that distribution curve. Some that would be aspirational and forward thinking, and others that are not. And our, as a country, opportunity is for those ones who are predisposed to want to invest. I think they are also more likely to start and join companies. They're also more likely to work their way up the ranks of organizations. They're more likely to lead professional firms. They're more likely to generate wealth and, generate influence and so on. And by being able to invest in companies and learn from them over a 10 or 20 year period means that they can apply that learning and those experiences to their professional career, as opposed to waiting until they're 65 and investing in a 10-year journey. Right. Yeah. And so that's I think our opportunity is to open the door more broadly.
Now you've got your partnership with Simplicity and I think it's a Kiwi Saver Fund. Walk us through how that kind of, opens things up to a broader audience.
Yeah, I'm, very grateful to Sam and the team for backing us, right? There's a mentor of mine who's, ran a significant fund offshore, and he talks about how in a presentation, nothing matters throughout the whole presentation in Q&A. It's just when they're, walking out the door and they're putting their coats on and they ask, who else is invested, right? And the point is that signaling is very important, and trying to find that first yes is extremely difficult. And that's what Simplicity was. They were the first Kiwi Saver to participate. And, I think have been a front runner that many others have now jumped in and followed, right? And it also, between Simplicity and then Generate, who supported our growth fund, and Pi funds, It means that like 250,000 plus New Zealanders now have exposure to Kiwi innovation, right? And that means they can learn from it and they can benefit from it. And that's the most important part for me is that, excuse me, is that storytelling that we're able to do about the companies to the individual Kiwi savers that are in those funds.
And how does that work from an investor perspective? And I'm probably a little bit naive on all the ins and outs of KiwiSaver because I've been self-employed for such a long time. I've never been offered a KiwiSaver or had the opportunity to participate. Although I probably could. I could go and I do receive a salary, so I could say, hey, carve some of that off into KiwiSaver. But I think most people have come in since KiwiSaver's been around, and so they've been automatically enrolled. How does that work in terms of investing with your funds and I guess people being able to get in and get out? Because with a wholesale investor, they're going to drop in X amount of funds into, I guess, one of your funds that runs for usually quite a long period of time, right, before they can cash out. How does that sort of look different, when it comes to the KiwiSaver side of things?
Yeah, maybe I'll explain the dynamic with wholesale investors in our funds, and then how that sort of works with KiwiSaver. If you're an individual, typically in our funds, which are right now only open to wholesale investors, you can commit a minimum of $50,000 in most cases. You pay that over a 4-year period, or sort of 4 tranches over 3 and a bit years. So 12 and a half. That is based on a strategy. So like our second growth fund, which we closed oversubscribed last year, said we're going to use our advantages to invest in 20 later stage New Zealand technology companies. So not startups, but companies that are 5, 6, 7 years old with revenue and product and so on. And so we've receive that money over those tranches. And then from the first day for the next sort of 5 years, we can invest that money into a set of companies. And in Growth Fund, it'll be probably 20. At any point, if one of those companies sells, pays a dividend, IPOs, fails, liquidates, if any event causes capital to flow back the opposite direction, that's paid out proportionately to the investors at that point. Which means, in the example from our first growth fund, we were still calling capital down when Tradeify was sold last year. So you're just paying out your final 12.5 if you'd committed 50,000, and you're getting money back immediately. Right. Okay. And then you're saying, okay, well, there's one company, I've got my money out, and now there's 19 more. And at the end of those 19, that's my total return. Right. And so it's not like a fund where you commit capital and then you liquidate it all at one point, right? You invest. We invested across a bunch of companies. When those companies reach their final destination, that's when we all benefit. Now, that creates liquidity challenges because essentially these funds are not liquid, right? You cannot, and because we're investing in illiquid, privately held New Zealand companies. Now, there is a market for high potential growth stage companies, right? And we are voracious buyers of shares in some of these companies that are still unlisted and illiquid. And so that means people are selling, right? And we've also been sellers, getting anywhere from 2 to 80 times our money back, selling shares before they have reached an exit or an IPO or whatever. So then you would say, well, how does that sort of work on KiwiSaver? Now, in a KiwiSaver's case, as an investor, you're one of many, potentially hundreds of thousands. You're contributing capital into pools. Usually they have multiple different funds. And then those funds can invest across a broad array of assets, right? Okay. And typically when they're investing in venture, they're investing a minutia, like a tiny fraction, not even like a percentage point into these funds. And the result is that illiquidity can be balanced because they have thresholds where they couldn't lock up 50% of their capital into something that couldn't be sold in case KiwiSavers wanted their money out, but they can do it into 1 or 2 or 3 or sometimes more percent. Yeah, okay.
So then they can change stream partway and
from a KiwiSaver investor can choose to invest in funds that do have growth assets like Icehouse Ventures, or they can choose to invest in other KiwiSavers that don't, even within certain providers, right? There's that spectrum. And because they're able to they're regulated and they manage their liquidity in a specific way, they can operate with either a high degree of certainty or complete certainty that anybody who wants to switch or sell can do so when they need.
Yeah, right. And are you considering other kind of options from a retail, perspective, a listed entity or, other things that
I think we want to stick to our knitting, which is venture capital. Yeah. But I do think there's approaches that are possible to make it more accessible to retail investors. And I mean, just to give you a sense of how much more accessible we've made it since we started, like in 2008, the average investment per investor, per company, per round, meaning, a company will come back 1, 2, 3, 4, 5 times, was $60,000, right? That's a lot, right? Once is a lot. And then you have an American fly in and say, well, you need a portfolio of 10 and, be prepared to follow half the time into second and third rounds. That's $1 million. I mean, that is both just absolutely a lot of money, but also just emotionally a ton because you have opportunity cost, right? Yep. Fast forward to 2017, we raised a fund that investors could commit $20,000 to. It was paid over 3 years, so $8,000, $8,000, $4,000, and it invested across 100 companies. Yeah, Halter, Henry, Sharesies, Dawn Aerospace, Mint Innovation, right, and dozens more like Tradeify and really interesting companies. And so the absolute amount that you're putting to work in an asset class that's illiquid and long term and high risk is a third, but it's also diversified across 100 companies across multiple years. And it's just a complete change, right? Yep. That doesn't make it accessible to everybody, and I accept that. But it makes it accessible to a heck of a lot more people than $60,000 per company per round. And so our opportunity is to just take a step a little bit further and say, well, who would be able to participate if it was $5,000 a year, or just $5,000 once, right? Yeah. And I think there would be a lot of aspirational people who are crescendoing into their careers who like innovation, who maybe even work for startups or work for high growth companies, or who want to start a company that would say, no, that is something I would invest in, And so that's the aspiration. We haven't launched anything, but I think it's a direction of travel that is important either for us or somebody else.
That's great. Really interesting to chat, Robbie. We've covered a fair few bases. Anything else you wanted to add before we wrap up?
No, I think I would just conclude by saying, there's lots of reasons to be really optimistic about the position we're in the world and with our entrepreneurs and with all these proof points that we're starting to see. And so, entrepreneurs should lean in and make the most of it. That's good. And something we chatted about before we started was all the tariffs kind of coming in. There's obviously sort of pros and cons of this. Any comments you could make in terms of when you're looking at your portfolio companies? Are there some that are upbeat because of the introduction of tariffs? There must be some who are obviously going to be impacted because of the amount of business they do in the US. Yeah, there's probably more that are negative as a result of uncertainty than there are positives, right? But gosh, in every instance, pandemics and macroeconomic shifts, there are some companies that are better poised to benefit from those changes. And this is possibly the same thing here. It's amazing how many companies have gone from being sort of branded as impact, waste reduction, recycling to critical minerals. And meaning, right, like instead of framing it as I can recycle X and that's good and we can do well and do good, you say, well, I can set up a facility in America and help America access critical minerals, for defense or data or whatever. And so that I think is representative of the sort of malleable approach that entrepreneurs take and find opportunities in everything. Interesting. Well, we look forward to seeing what's next and, following the journey, Icehouse Ventures and your varying companies. And, I'm sure there'll be listeners who will be looking up the Kiwi Saver options and maybe curious around some of your investor events. For folks who are wanting to maybe get on an email list and get updated about your investor events, is that just sort of duck across to Icehouse Ventures website? Yeah, the website's there. We host a variety of events each year, including our big annual showcase on the floor of Spark Arena that's coming up in August. And we're very accessible, so it's not hard to get introduced or get my email from you. So, that's good. Oh, thanks so much, Robbie. Really appreciate it. Thanks, Paul. And of course, a big thank you to our show partners, Gorilla Technology, HP, 2 Degrees Spark,
and 1 NZ. Thanks everyone for listening in, and we will catch you again on the next episode next week.
The New Zealand Tech Podcast, brought to you by Gorilla Technology, proactive and strategic IT.